Hello everyone, welcome to weekly lecture videos once again. This is the second video of chapter 14, and in this video I'll be covering the second learning objective of this chapter, issues surrounding dividend policy, or I will mostly talk about whether dividend policy matters. Look, to decide whether dividend policy matters, we first have to define what we mean by dividend policy, all right? All other things being the same, of course, dividends matter. Dividends are paid in cash, and cash is something that everybody likes. The question that we will be discussing here is whether the firm should pay out cash now or invest the cash and pay it out later. Therefore, the dividend policy relates to the time pattern of dividend payout. In particular, should the firm pay out a large percentage of its earnings now or a small percentage? So this is the dividend policy question. Okay. Now, an illustration of the dividend irrelevance. An argument can be made that dividend policy does not matter. Okay, so we illustrate this by considering a simple case of Wharton Limited. Wharton is an all-equity firm that has existed for 10 years. The current financial managers plan to dissolve the firm in 2 years. The total cash flow the firm will generate, including the proceeds of liquidation, are $10,000 each year. Okay, $10,000 each year for next 2 years. At present, dividends at each date are set to equal to a cash flow of $10,000. There are 100 shares outstanding, so the dividend per share is going to be $100. Okay, so $10,000 dividend per year, 100 shares, so there will be $100 per share. Okay. Recall from chapter 7, where we learned that the value of a share is equal to the present value of all future dividends. So assuming a 10% required return, the value of the share today should be 173.55. Okay, so 10% is the required rate of return. So as you receive a cash flow of $10,000, okay, and if you find out the present value for each share, so $100 per share, $100 comes at year one. Okay, you can see $100 comes at year one, $100 comes at year two. And if you find out their present value and sum them up, you will find that it is 173.55. Okay, so if that is the case, the firm as a whole worth 17,355. Why? Because there are 100 shares, so these 173 multiplied by 100, so it's 17,355. That will be the whole worth of the company. Several members of the board of Wharton have expressed dissatisfaction with the current dividend policy and have asked you to analyze an alternative policy. Okay, so what is the alternative policy? Another policy is for the firm to pay a dividend of $110 per share on the first date, which is day one, which is of course a total dividend of $11,000. Okay, so total of $11,000. An extra $1,000 must somehow be raised. So you have $10,000, right? But if you want to pay $11,000 as dividend, you need to raise $1,000. One way to do this is issue $1,000 worth of shares at date one. So you issue more shares. The new shareholders will desire enough cash flow at day two so that they earn a required rate of return of 10% on their investment in date one. So what is the value of the firm with the new dividend policy? Okay, the new shareholders invest $1,000. Okay, so new shareholders invest $1,000. They require a 10% return, so they will demand 1,100. Okay, so they will demand 1,100 in day two, leaving 8,900. So this is 8,900 for the old shareholders. Don't forget that there is 1,000, there $10,000 cash flow every year. So if you pay 1,100 to new shareholders, what you leave with is 8,900 for the old shareholders. The dividend to the old shareholders will therefore be now $89 per share. Okay. So 100 shares, so 8,900 divided by 100. So it will be $89 per share. Okay. Now, the present value of the dividends per share will therefore again be 173.55. That means $110 in year one and $89 in year two. So it's again 173.55. Okay. So you see that the value is the same as before. Now, the value of the share is not affected. You see that the value of the share is same in both the dividend policies. Now, the value of the share is not affected by the switch in dividend policy, even though we had sell some new shares just to finance the dividend. In fact, no matter what pattern of dividend payout the firm chooses, the value of the share will always be the same in this example. In other words, for the Wharton Limited, the dividend policy makes no difference. Okay, the reason is simple. Any increase in dividend at some point in time is exactly offset by decrease somewhere else. Okay, I repeat, any increase in a dividend at some point in time is exactly offset by a decrease somewhere else. So the net effect, once we account for time value, is zero. Okay. So our discussion to this point can be summarized by considering following two questions. Okay. True, false test question. One is true or false, dividends are irrelevant, and true or false, dividend policy is relevant. Now look, the first statement that dividend irrelevant, okay? Dividend irrelevant. So if the first statement is dividends are irrelevant, true or false, then this statement is surely false. And the reason follows from common sense. Clearly, investors prefer higher dividends to lower dividends at any single date if the dividend level is held constant at every other day. So you will want more now, right? To be more precise regarding the first question, if the dividend per share at a given date is raised while the dividend per share at every other date is held constant, the share price will rise. Okay. The reason is that the present value of the future dividend must go up if this occurs. This action can be accomplished by management decision that improve productivity, increase tax savings, strengthen product marketing, or otherwise improve cash flow, so that if you can give dividend at a higher rate today and hold the future dividend constant, the share price should go up. Okay. The second statement that whether dividend is relevant, okay, whether dividend is relevant, this statement is true, at least in the simple case we are talking about. Okay, dividend policy by itself cannot raise the dividend at one date while keeping it same at all other dates. Rather, dividend policy merely establishes the trade-off between dividends at one date and dividends at another date. Once we allow for time value, the present value of dividend stream is unchanged. Thus, in the simple world, dividend policy does not matter because managers choosing either to raise or to lower the current dividend do not affect the current value of the firm. However, we have ignored several real-world factors that might lead us to change our minds. So we talk about some of them in the next few slides. So some real world factors favoring a low payout. To example, what we used to illustrate the irrelevance of dividend policy, we ignored taxes and flotation costs. Okay, so let's discuss these 2 points. First of all is taxes. Tax laws are complex. Okay, tax laws are complex, either in Australia or elsewhere, and they affect dividend policy in a number of ways. Okay. The key tax feature has to do with the taxation of dividend income and capital gains. Under a classical tax system, it is quite common for the tax rate applied to capital gains to be less than the rate that applies to dividends. Okay. Also, the tax is on the capital gains amount, but not the total sales amounts. Okay, so capital gain tax is on the gain, not on the total sales amount. This tax is not paid until the shares are sold, which, because of the time value of money, further reduces the effective tax rate on capital gains. So from a tax perspective, it does not appear warranted for a firm to pay dividends under a classical tax system. Okay, so why? Because if a company pays dividends, it will be taxed at a higher rate compared to capital gain. So instead, companies should hold cash and invest. So that should increase the share price. As if the share price increases, shareholders are left with the option to sell their share at a higher price. Okay, and they pay taxes at a lower rate, and they also get tax advantage on that, and also they can defer the tax payment until they sell their share. Okay. Under an imputation system, the effective tax rate applying to the cash dividend can be much lower than the rate applying to capital gains. Okay, so as we discussed in chapter 2, if you remember, the dividends in the hands of the resident shareholders is increased by the Australian tax paid by the company, okay, which is called franking credit, which the shareholders received in the form of tax rebate. The overall tax effect will depend on shareholders' marginal tax rate, but for some, the cash component of dividend will be tax-free or may generate a tax refund. In general, from a tax perspective, under an imputation system, domestic shareholders will prefer to pay out all of the dividends that could be fully franked, while overseas shareholders will prefer dividend to be kept to a minimum. Okay, the general conclusion of this discussion is that a classical tax system favors the payment of low dividends because shareholders will like capital gain, so they pay less taxes, while up to a point, an imputation tax system could favor the payment of high dividends. Okay. The next point is flotation costs, the cost of selling shares. So in our example previously, that we illustrated the dividend policy does not matter, we saw that firm could sell some new shares if necessary to pay a dividend. As we will be discussing in the next chapter in this week, selling new shares can be very expensive. Okay, if we include the cost of selling shares, that is called flotation cost in our argument, we will find that the value of shares decreases if we sell new shares. Okay, more generally, consider two firms identical in every way except that one pays out a greater percentage of its cash flow in the form of dividends. Since the other firm plows back more, its equity grows faster. If these two firms are to remain identical, then one with a higher payout will have to sell some shares periodically to catch up. Since this is expensive, a firm might be inclined to have a low payout. Okay. Then dividend restrictions. In some cases, a company may face restrictions on its ability to pay dividends. Okay, so if you can remember, we discussed in chapter 6, a common feature of a bond or debenture trust deed is a covenant prohibiting dividend payments above some level. Also, a company may be prohibited by law from paying dividends if the dividend amount exceeds the firm's retained earnings. Okay. So in summary, the taxes, flotation costs, and dividend restriction um, may motivate companies to pay less dividends. Okay, so once again, if you pay more dividend, then you might need to issue new shares to raise funds, and that is expensive. That's why companies might opt to pay less dividend. And dividend restriction, obviously, company might want to pay low dividend because of this restriction. And for taxes, as I already indicated, that in a classical tax system, the companies might opt to pay less dividend, rather allow investors to earn capital gain so that they are subject to less tax. Okay, now some real world factors favoring a high payout. Let's consider why a firm might pay its shareholders higher dividends, even if it means the firm must issue more shares to finance the dividend payments. As discussed in the previous slide, the tax laws are complex and they affect how shareholders may value the payment of a dividend. Okay, so let's discuss a little bit more. First of all, desire for current income. It has been argued that many individuals desire current income. The classic example is the group of retired people or others living on their capital. It is argued that this group is willing to pay a premium to get a higher dividend yield, even if it is taxed, and fully franked dividends would be preferred even more. Okay, so retired people or the people who live on the income generated from their investment, they would want higher dividend. It is easy to see, however, that this argument is not relevant in the world we described, where dividends are irrelevant. In such a world, an individual preferring high current cash flow but holding low dividend securities could easily sell off shares to provide the necessary funds. Similarly, an individual desiring a low current cash flow but holding high dividend securities could just reinvest the dividends. Okay, so thus, in a world with no transaction costs and taxes, a policy of high current dividends would be of no value to shareholders. You understand the point? So, for example, if you are living on the income generated from your investment, but your share pays low dividend, so you can sell some of the shares. Okay, some of the shares to get your necessary income. Okay. On the other hand, if you are holding, if you want more. If you do not want more dividend, you want low dividend, but you have invested in shares that pays high dividend, so you can reinvest your dividend income. Okay, so you see that dividend is irrelevant if there is no transaction costs and taxes. The fact that some investors have a strong preference to receive or to avoid cash dividends may have relevance in the real world. Here, the sale of low dividend shares would involve brokerage fees and other transaction costs. Such a sale might also trigger capital gains taxes. These direct cash expenses could be avoided if an investment in high dividend, if you invest in high dividend. So it means that investing in high dividend shares and investing in low dividend shares and selling of some of the shares is not equal to investing in high dividend shares, okay? Because investing in low dividend shares and selling some of them will incur you brokerage fees, transaction costs, and capital gain taxes. That's why you might want to invest in high dividend shares and simply receive high dividends instead of selling some of your shares. In addition, the expenditure of the shareholders' own time when required to sell securities to meet their cash needs and the natural fear of consuming out of principal might further lead many investors to have a preference for high dividend securities. And of course, preference for high dividends may be somewhat mitigated by an investor's tax situation. Under a classical tax system, there is a normal preference against high dividends because they will surely be taxed at a higher effective tax rate than capital gain tax, although this may not be such a problem for those favoring high dividends who may not have significant income from other sources. Okay. So before we go to the next point, it is appropriate to point out that much of what we are discussing here is commonly described as a dividend clientele effect. Okay, I will be talking about a little bit more about clientele effect soon. Now, the tax and legal benefits from high dividends. Now, so far we discussed that when you receive high dividends, that is taxed at a higher rate. Okay, so but there are some tax and legal benefits from high dividends too. So the fact is a powerful argument. The fact that we're going to talk about is a powerful argument for a high payout. However, a number of other investors do not receive favorable tax treatment for holding high dividend rather than low dividend. For example, overseas investor who cannot use the franking credit may not favor this argument. Okay, so first of all is corporate investors. A significant tax break on dividends occur when a company in Australia owns shares in another company. So fully franked ordinary or preference dividends paid to a corporate shareholders are effectively tax-free income in the company's hand. Okay, so if a company earns dividends, okay, preferred dividends, and then it is tax-free income. Since this tax-free effect does not apply to capital gain, this group of tax unfavorably on capital gain. That means they will like dividend instead of capital gain because their dividend income is tax-free. As a result of this tax-free effect of dividends, high dividend, low capital gain shares may be more appropriate for companies to hold. In fact, this is why companies hold a substantial percentage of the outstanding preference shares. This tax advantage of dividends also leads some companies to hold high-yielding shares instead of long-term bonds because there is no similar favorable tax effect on interest payments to company debt holders or company bond holders. The next point is tax-exempt investors. We have pointed out both the tax advantage and tax disadvantage of a low dividend payout. Of course, this discussion is irrelevant to those in zero tax bracket. This group includes some large investors in the economy, such as charitable institutions and superannuation funds who pay no tax or tax at a concessional rate. There are some legal reasons for large institutions to favor high dividend yields. First, institutions such as superannuation funds and trust funds are often set up to manage money for the benefit of others. The managers of such funds have a fiduciary responsibility to invest the money prudently. It has been considered imprudent in courts of law to buy shares in companies with no established dividend record. Okay, so you understand that if you're managing a superannuation fund, then by law, you cannot invest in shares. They pay low dividend or no dividend. Okay. Second, institutions such as university endowment funds and trust funds are frequently prohibited from spending any of the principal. And such institutions might therefore prefer high dividend in shares, so they have some ability to spend. Okay. Like widows and orphans, this group does prefer current income. Okay. Overall, individual investors, for whatever reasons, may have a desire for current income and may thus be willing to pay the dividend tax. In addition, some very large investors, such as corporations and income tax exempt organizations, may have a very strong preference for high dividend payouts. Okay, as I mentioned that I will be talking a bit more about the clientele effect. Look that in our earlier discussion, we saw that some groups, wealthy individuals, for example, have an incentive to pursue low payout or zero payout shares. Other groups For example, corporations have an incentive to pursue high payout shares. Okay, so companies with high payout will thus attract one group, and low payout companies will attract another. These different groups are called clienteles, and what we described as a clientele effect. The clientele effect argument states that different groups of investors desire different level of dividends. When a firm chooses a particular dividend policy, the only effect is to attract a particular clientele. Okay, so if a firm changes the dividend policy, then it just attracts a different clientele. Now, the implications for the clientele effect. So look, our so far discussion from the clientele effect is simply we are left with a simple supply and demand argument. Okay. Suppose 40% of all investors prefer high dividends, but only 20% of the firm pays high dividends. Here, the high dividend firms will be in short supply, so their share price will rise. Consequently, low dividend firms will find it advantageous to switch policies until 40% of all firms have high payouts. So at this point, dividend market is in equilibrium. Further changes in dividend policies are pointless because all the clienteles are satisfied. The dividend policy for any individual firm is now irrelevant. Okay. So to see if you understand this clientele effect, consider the following statement. In spite of the theoretical argument of the dividend policy is irrelevant or that firms should not pay dividends, many investors like high dividends because of the fact a firm can boost its share price by having a higher dividend payout ratio. True or false? Okay. The answer is false if clientele exists. Okay, as long a sufficient number of high dividend firms satisfy the dividend loving investor, a firm will not be able to boost its share price by paying high dividends. An unsatisfied clientele may exist for this to happen, and there is no evidence that this is the case. Okay, so this is the end of our discussion about dividend theories and the issues surrounding the dividend policy. Okay, so thank you very much.